Here's something nobody at your bank wants you to figure out. Right now, somewhere in a glass-walled boardroom on the 40th floor of a major financial institution, a group of very expensive suits are having a very uncomfortable conversation about Bitcoin. Not about whether it's real, not about whether it's here to stay, but about what happens to them if it keeps winning. And here's the wild part. This isn't new. Banks have been terrified of Bitcoin since the moment Satoshi Nakamoto published that 9-page white paper back in 2008. But something has shifted. The fear has changed shape. It's gotten quieter, more calculated, and a whole lot more dangerous for the average person sitting in a bank account earning 0.01% interest while inflation eats their savings alive. Today, we're pulling back the curtain. We're going to talk about why banks, the most powerful financial institutions in human history, are legitimately scared of a decentralized digital currency that didn't even exist 17 years ago. We're going to talk about the numbers they don't want you to see, the moves they're making behind closed doors, and what all of this means for you, your money, and your future. Because here's the truth. The banks aren't just afraid of Bitcoin as a technology. They're afraid of what Bitcoin represents. They're afraid of you understanding it, and they are absolutely terrified of the moment you stop needing them. So let's get into it. This is why your bank is secretly terrified of Bitcoin right now. Point 1. Bitcoin is doing what banks were supposed to do, but better. Let's start at the foundation. What does a bank actually do? Strip away the marble lobbies and the free pens and the commercials with happy families buying their first home, and what you're left with is this. A bank stores your money, moves your money, and lends your money to other people at a profit. That's it. That is the entire business model. And for roughly 300 years, that model worked because there was no alternative. If you wanted to save money, you needed a bank. If you wanted to send money across borders, you needed a bank. If you wanted to access capital, you needed a bank. The bank was the gatekeeper, the toll booth, the middleman that every single financial transaction on Earth had to pass through. Bitcoin changed that equation permanently. Think about what Bitcoin actually does. It lets you store value without a third party. It lets you send money anywhere on Earth in minutes without asking anyone's permission. It operates 24 hours a day, 7 days a week, 365 days a year. No holidays, no maintenance windows, no please try again after 3 to 5 business days. It doesn't discriminate based on your credit score, your nationality, your political beliefs, or whether you're on some internal watch list you don't even know exists. And here's the kicker. It does all of this on a transparent, immutable blockchain ledger, where every single transaction is publicly verifiable, and no single entity controls the rules. Compare that to a traditional bank, where your account can be frozen without warning, where international wire transfers can take 3 to 5 business days and cost you $45, where the bank can and does lend out up to 90% of your deposits through fractional reserve banking, essentially using your money to make themselves rich while paying you almost nothing in return. The numbers here are staggering. According to data tracked across global banking institutions, the average savings account in the United States was paying somewhere between 0.01% and 0.06% annual interest for years during the low-rate environment. Meanwhile, Bitcoin went from essentially zero to over $100,000 per coin in its first 15 years of existence. Now, yes, Bitcoin is volatile. Nobody is pretending otherwise. But here's what the banks don't want you thinking about. Over every 4-year period in its entire history, Bitcoin has ended higher than it started. Every single one. That's not a coincidence. That's a system doing exactly what it was designed to do. When Michael Saylor, the co-founder of MicroStrategy, explains Bitcoin, he always comes back to one central idea. Bitcoin is the first engineered monetary asset in human history. It has a fixed supply of 21 million coins. It cannot be inflated, it cannot be debased, it cannot be printed at will by a committee of 12 people meeting in Washington, D.C. And that scares banks to their core. Because the moment people realize that a decentralized digital asset can do what banks do, but faster, cheaper, more transparently, and without the permission of anyone, the question stops being, why would I use Bitcoin? And starts being, why would I keep using a bank?
Point 2. The attack playbook. How banks have been fighting Bitcoin for years. Now, here's where it gets really interesting. Banks didn't just wake up one morning, look at Bitcoin, and decide to embrace the future. They fought back, hard. And if you've been paying attention to the crypto space over the past decade, you've seen this playbook run in real time. Step 1. Dismissal. Go back and look at the headlines from 2011, 2013, 2015. Bitcoin is a joke. It's for criminals. It'll be worth 0 by Christmas. Jamie Dimon, the CEO of JP Morgan Chase, one of the most powerful banks on the planet, famously called Bitcoin a fraud in 2017. He said he would fire any JP Morgan trader caught trading it. You know what JP Morgan did 3 years later? They launched their own blockchain network. They created JPM Coin. They started offering their wealthy clients access to Bitcoin funds. And Jamie Dimon, while still occasionally talking down Bitcoin in public, oversaw an institution that became deeply embedded in the digital asset ecosystem. That's not a coincidence. That's what the dismissal phase always turns into once the technology proves it isn't going away. Step 2. Regulatory capture. This is the sophisticated move, and it's the one that most people miss. Banks don't just fight new technologies with words. They fight them with lobbying, with legislation, with regulatory pressure applied in the corridors of power where the public never gets to see what's actually happening. For years, traditional financial institutions poured enormous resources into lobbying efforts designed to create regulatory ambiguity around cryptocurrency. Not to ban it outright, because they knew that ship had sailed, but to keep it in a legal gray zone where the average person was too intimidated or too confused to participate.
Think about the years of uncertainty around whether Bitcoin was a security, a commodity, or a currency. Think about the SEC's prolonged battle against spot Bitcoin ETFs, applications that were filed as early as 2013 and rejected again and again and again, while the institutional money quietly accumulated in the background. And then, in January 2024, something historic happened. The SEC approved the first spot Bitcoin ETFs in the United States, and within days, billions of dollars flooded in. BlackRock's Bitcoin ETF, the iShares Bitcoin Trust, became one of the fastest-growing ETFs in the history of financial markets. The bank spent years trying to keep that door closed, and when it finally opened, they ran through it first. Step 3. Co-option. This is where we are right now, and it might be the most dangerous phase of all. Not for Bitcoin, but for the people who thought the banks would stay on the outside looking in. Major financial institutions are no longer trying to kill Bitcoin. They're trying to own as much of the infrastructure around it as possible. Custody services, trading desks, ETF products, payment rails. The goal isn't to destroy the revolution. The goal is to become the revolution's landlord. BlackRock, Fidelity, JP Morgan, Goldman Sachs, these aren't Bitcoin believers. They are capital allocators responding to client demand and sensing an extraordinary business opportunity. And the fact that they're all racing each other to get there should tell you everything you need to know about how real this is. Because these institutions don't move on things that are going away. They move on things that are going to define the next era of global finance.
Point 3. The inflation secret. What banks know that they hope you don't. Here's a conversation that nobody in mainstream finance wants to have out loud. The banking system, as it currently exists, is structurally dependent on inflation. Not just okay with it, dependent on it, built around it, optimized for a world where the purchasing power of paper currency slowly, quietly erodes year after year. Let's talk about why. When a central bank, like the Federal Reserve in the United States or the European Central Bank here in Europe, creates new money, that money has to go somewhere. And in the modern financial system, it flows first to the banks. The banks get access to cheap capital, which they can then lend out at higher rates,
which is how they generate enormous profits, essentially from nothing. Meanwhile, the average person holding cash in a savings account watches their purchasing power shrink. That 10,000 euros you saved 5 years ago, thanks to years of elevated inflation, it buys meaningfully less today than it did when you put it in the bank. This is not an accident. This is a feature, not a bug, of a system designed to reward borrowers and financial intermediaries over savers. Bitcoin was specifically engineered to be the opposite. The total supply of Bitcoin is capped at 21 million coins. No government, no central bank, no committee of economists can change that number. The issuance schedule is written into code. Approximately every 4 years, the rate at which new Bitcoin enters circulation is cut in half in an event known as the halving. This means Bitcoin gets harder and harder to produce over time, while demand, driven by a growing global awareness of what it represents, continues to build.
This is what people mean when they say Bitcoin is digital gold. Gold has maintained purchasing power across centuries because its supply is finite and difficult to extract. Bitcoin takes that concept and makes it mathematically guaranteed rather than just geologically limited. Now here's where the bank's terror becomes very specific. If ordinary people, not just hedge funds, not just Silicon Valley venture capitalists, but ordinary working people in Rotterdam, in Lagos, in Buenos Aires, in Manila, start holding even a small percentage of their savings in Bitcoin instead of bank deposits, the entire fractional reserve system faces a structural challenge it has never encountered before. Remember, banks need deposits. They need your money sitting in their accounts so they can lend it out and collect the spread. Every euro or dollar that moves from a traditional bank account into a self-custody Bitcoin wallet is a euro or dollar that the bank can no longer use to generate revenue. Scale that up by even a few percentage points globally, and you're talking about a fundamental shift in the balance of financial power. And the banks know this. They've run the models. They've done the analysis. They understand exactly what is at stake. That's why the public-facing messaging from legacy finance has been so consistently negative about Bitcoin, even as their private actions have been moving in the exact opposite direction. It's not confusion, it's strategy.
Point 4. The unbanked revolution. Bitcoin's billion-person army. Now let's take this global. Because one of the most powerful and least talked about dimensions of Bitcoin's threat to traditional banking isn't happening in New York or London or Frankfurt. It's happening in places where the traditional banking system never showed up in the first place. There are approximately 1.4 billion adults in the world today who are completely unbanked. No bank account, no access to credit, no way to send or receive money through traditional financial channels. These are people in sub-Saharan Africa, Southeast Asia, Latin America, and parts of South Asia who have been excluded from the global financial system, not because they don't want access, but because the banks decided it wasn't profitable enough to serve them. Think about what that means in practice. A small business owner in rural Nigeria can't accept international payments. A migrant worker in Malaysia can't send money home to their family without paying predatory fees to a wire transfer company. A farmer in El Salvador has no way to save in a currency that holds its value. Bitcoin changes all of that with a smartphone and an internet connection. El Salvador made global headlines in 2021 when it became the first country to adopt Bitcoin as legal tender. And while the experiment has been complicated and politically controversial, the underlying data told a fascinating story. Remittance costs, which previously consumed enormous percentages of the money being sent home by Salvadorans working abroad, dropped dramatically for people using the Bitcoin network.
But it goes further than remittances. In countries experiencing currency crises, and we've seen this in Venezuela, in Argentina, in Turkey, in Lebanon, ordinary people turn to Bitcoin not as a speculative investment, but as a survival tool, a way to preserve savings when their national currency was losing value so fast that waiting even a few days to convert could mean losing a significant portion of your purchasing power. When a Nigerian, an Argentine, or a Lebanese family with no access to a brokerage account or a foreign currency account can download an app and hold an asset that the government cannot confiscate, cannot inflate, and cannot control, that is a seismic shift in global economic power. And the traditional banking system, built entirely on geographic monopolies and regulatory moats, has no answer for it. This is what Coin Bureau's Guy Turner has been documenting for years. This is what Altcoin Daily covers when they go beyond the price action to talk about Bitcoin's actual use cases in the real world. The narrative that Bitcoin is just digital gold for wealthy speculators is a story that banks and their media allies have worked hard to promote. Because the moment the average person understands that Bitcoin is a financial liberation tool, not just an investment asset, the calculus changes entirely.
Point 5. The Bitcoin Strategic Reserve. When governments start stacking Bitcoin right now than they have ever been at any point in history. Governments are starting to buy Bitcoin. Not just allow it, not just regulate it, actually acquire it as a strategic reserve asset. In early 2025, the United States government, under executive order, moved to establish what was called a strategic Bitcoin reserve, using Bitcoin already seized through law enforcement actions rather than purchasing it on the open market. This was a watershed moment. The world's largest economy officially recognizing Bitcoin as a reserve asset worth holding. And the implications of this are absolutely enormous. Think about it from a game theory perspective, a concept that the Bitcoin community has been discussing for years through the framework popularized by thinkers like Saifedean Ammous and later amplified by figures like Michael Saylor. Once one major nation-state starts accumulating Bitcoin as a strategic reserve asset, every other nation-state faces pressure to do the same. Because if Bitcoin continues to appreciate in value, which it has consistently done over long time horizons, then the countries that moved early will be sitting on assets worth dramatically more than the countries that waited. This is a global game of monetary musical chairs, and the music is already playing. Several US states have also moved to create their own Bitcoin reserve legislation. Countries in Asia, the Middle East, and Eastern Europe have been quietly accumulating. Even in Europe, the conversation is shifting from should we restrict this to can we afford not to participate?
Now ask yourself, what does this mean for banks? If Bitcoin becomes a recognized reserve asset at the sovereign level, sitting on the balance sheets of central banks and treasury departments alongside gold and foreign currency reserves, it transforms from a speculative digital asset into a pillar of the global monetary system. And if that happens, if Bitcoin achieves that level of institutional and governmental legitimacy, the entire argument for keeping your wealth inside the traditional banking system becomes considerably harder to make. Because why would you trust an institution that pays you 0.5% interest and can freeze your account at will, when you could hold an asset that is recognized by major governments as a store of value, that appreciates over long time horizons, that cannot be debased, and that you can self-custody in a cold wallet that no bank, no government, and no hacker can access without your private key? The banks understand this logic, and it terrifies them. Ryan's Money Lab has been covering this institutional adoption wave from the retail investor perspective. Mark Moss has been connecting these macro dots better than almost anyone. And what they're both pointing to is the same thing. We are in the middle of a once-in-a-generation monetary transition, and most people are still sleepwalking through it.
Point 6. The blockchain revolution they can't control. Here's the final layer of the fear, and it might be the deepest one. It's not just Bitcoin, it's what Bitcoin started. The blockchain technology that underlies Bitcoin has spawned an entirely parallel financial system. Ethereum, Solana, Avalanche, and dozens of other smart contract platforms have made it possible to do things that would have been unimaginable in traditional finance just a decade ago. Decentralized finance, DeFi, allows anyone to lend, borrow, trade, and earn yield on their assets without a bank, without a broker, without any intermediary at all. The protocol is the bank. The smart contract is the legal agreement. The blockchain is the ledger. Total value locked in DeFi protocols has fluctuated dramatically with market cycles, but the infrastructure has matured enormously.
We now have decentralized exchanges processing hundreds of billions of dollars in trading volume. We have lending protocols that allow anyone to collateralize their crypto assets and borrow against them instantly. We have stablecoins, digital assets pegged to the value of traditional currencies that can be sent anywhere on Earth in seconds for fractions of a cent. The traditional banking system charges you fees at every single point of this value chain. DeFi, at its best, eliminates those fees entirely. Now, DeFi has its own risks: smart contract vulnerabilities, regulatory uncertainty, the complexity of managing self-custody. These are real challenges that Coin Bureau, Elio Trades, and Discover Crypto all cover extensively and honestly. Nobody in the serious crypto education space is pretending that decentralized finance is frictionless or risk-free. But here's the trajectory that matters. In 2017, DeFi essentially didn't exist. In 2019, it was an experiment. In 2021, it was a multi-billion-dollar ecosystem. By 2024, it was an established, battle-tested alternative financial infrastructure that was processing enormous volumes and attracting institutional attention.
Each year, the technology gets better. Each year, the user experience gets smoother. Each year, the regulatory framework becomes clearer. And each year, the gap between what decentralized finance can offer and what traditional banking offers narrows. Banks know this. They've hired blockchain developers. They've built internal research teams. They've issued endless reports analyzing the DeFi landscape. And what those reports all say, in various ways, is the same thing. This technology has the potential to disintermediate significant portions of our business model. That's banker speak for, we are scared. The question, and this is the question that every thoughtful person in the crypto space is wrestling with right now, is whether the banks will successfully co-opt enough of this technology to protect their position, or whether the decentralized architecture will prove resilient enough to build a genuinely parallel system that operates independently. The honest answer is probably both, in different parts of the world, for different use cases over the next 20 years. But here's what's not going back: the knowledge. Once people understand, really understand, that money can work without banks, that value can be stored without custodians, that transactions can be verified without intermediaries, that understanding cannot be unlearned. The genie doesn't go back in the bottle. And that is the deepest terror of all. Not that Bitcoin will replace banks tomorrow, but that a generation of people, digital natives, emerging market participants, financially excluded communities, and intellectually curious investors everywhere are learning to see the financial world through a completely different lens. A lens where the bank is optional. A lens where your monetary sovereignty is a default right, not a privilege granted by an institution. A lens where 21 million coins and an open source protocol are more trustworthy than any boardroom full of suits making decisions about your money without your input.
Closing. What you do with this changes everything. So let's bring this home. Let's talk about what all of this means for you, sitting here right now. The banks are terrified of Bitcoin because Bitcoin works. Not perfectly, not without volatility, not without complexity, but it works as a store of value. It works as a transfer mechanism. It works as a check on the power of monetary authorities who have throughout history consistently abused the privilege of controlling a currency. The banks are terrified because they spent a decade trying to dismiss it and it didn't go away. They spent years trying to regulate it into irrelevance and it only grew stronger. They watched governments begin to accumulate it. They watched their own clients demand exposure to it. And now they find themselves in the strange position of simultaneously talking it down in public while building infrastructure around it in private. The banks are terrified because the math is simple. In a world where every major central bank has expanded its money supply by extraordinary amounts over the past 15 years, an asset with a hard cap of 21 million units, an asset that gets provably scarcer over time, is not just a speculative bet. It's a hedge against the one thing that the entire modern financial system runs on: the unlimited ability to print money. And the banks are terrified because of you. Not you specifically,
but the version of you that watches a video like this, the version of you that goes and does the research, that reads the Bitcoin white paper, that downloads a wallet, that moves even a small amount of savings into an asset that no one can inflate, no one can freeze, and no one can take without your private key.
Because every person who does that is one more person who doesn't need to ask permission to participate in the global economy. One more person who understands that money is a technology, and like all technologies, the version we're using can be upgraded. Now, none of this means you should put your entire life savings into Bitcoin tomorrow. That's not what this is about. Risk management matters. Portfolio diversification matters. Understanding what you own and why you own it matters. But what this absolutely means is that you owe it to yourself to understand what is happening, to understand why some of the most powerful financial institutions in human history are spending enormous resources trying to shape your perception of this technology, to understand what is at stake in the conversation about the future of money, a conversation that is happening right now, whether you participate in it or not. The banks are scared because the truth is spreading faster than they can contain it. This video is part of that truth. And if it made you think differently about your money, about Bitcoin, about the system we all live inside, then share it. Not because we need the algorithm points, but because the people in your life deserve to understand what is happening too. Hit subscribe if you want to keep going deeper on this. We cover Bitcoin, blockchain technology, decentralized finance, and the macro forces reshaping the global economy, without the noise, without the hype, and without the permission of anyone who would prefer you stay uninformed. The banks are terrified. Maybe they should be. See you in the next one.